Management of Mastek, who's joining us on the show to discuss numbers, robust revenue growth, margin expansion, and lots more. We have Hiral Chandrana, who's the CEO, with us live. Thank you so much for taking time out. And there had been subsequent quarters, 2 to 3, if I'm not mistaken, of disappointment. And finally, we've seen a bounce back in growth with this 5% cross-currency growth. What really has led to it? Would it be attributed largely to the contribution from acquisition?
So thanks for having me in the show, and good morning. I am very pleased with the Q4 results. Like you said, we did have challenges earlier in the year, and the team has done a fantastic job in quarter execution, as well as some of the changes that we've been making and some of the foundational work that we've done over the last year or so is starting to yield results. We did have 5.3% constant currency growth on INR and US dollar terms. That was 7.7%. Quarter on quarter. So that's a very healthy quarter on quarter growth. Full year basis also was in the 18-19% range in terms of constant currency. And our EBITDA, in spite of some of the macro uncertainties, is in that 17.7-17.8% range. So all in all, we see a very good, strong closure for the fiscal year with momentum on deals as well as order backlog going into FY24.
Okay, good to know. So given this acquisition ramp up will now fully be shown in the coming quarters, can we then assume that there will be growth expansion for FY24, given that the constant currency growth rate was 18.5% for FY23? So what can you extrapolate for FY24?
Yeah, absolutely. So the acquisition that we had made in the middle of last year, MST Solutions, which is now fully integrated as part of the Mastek family. It's our Salesforce business unit. And over the last 8 months, it's actually exceeded our expectations. They have beat their plans, both on order book revenue as well as on margins. But this quarter in Q4, a lot of the growth that we saw is completely organic. Normally, this Q4 is a slower quarter for our Salesforce business, but overall, they've been around 120% of plan. So we're looking at them as a strong engine going forward, building on top of our Oracle cloud business and our digital engineering business. So as we look at FY24, our pipeline has grown. Our order backlog, 12-month order backlog has grown. We have won some marquee deals. There is still a lot of macro uncertainty, as you know, particularly in the UK and the US regions. But the way we are engaging with our clients is not just looking at having them spend money, but also save money, right? So it's a combination of moving to the cloud, digitizing, while optimizing your back office or front office. So that message is starting to resonate. We're starting to see larger average deal sizes. We've had some interesting wins across geographies in US, UK, even in Middle East and Australia, which are greater than 5 million type of wins in the implementation space, but combining that with managed services and cost savings as well. So as we look at FY24, our Oracle business, our Salesforce business continues to be very strong. We see an opportunity to pivot on the digital engineering side towards larger transactions and deals. And from a market perspective, we've hired a very strong leader in the Americas, and he's starting to make a difference already. We have some bets on certain industries like healthcare, for example. Our UK public sector continues to be resilient. Our Middle East business has actually positively surprised us, both in terms of execution as well as FY24 outlook. So we are confident of beating industry average growth rates and doing slightly even better than that in terms of FY24.
But while your margins have improved sequentially, costs have also remained elevated, especially employee costs, which is jumped 10% sequentially. Do you see margins heading to those 21% kind of historical levels, or 18 to 19% you think is more realistic a range for FY24?
Yeah. So Asha, I mean, I think we've given the commentary that we are comfortable with the high teens kind of range. Definitely, we'd want to actually demonstrate strong, consistent quarter-on-quarter, year-on-year growth. That's our priority, while maintaining that margins in that kind of 18% range. We don't guide necessarily for margins or revenue, but we're comfortable in the range that we're in and in that high teens, because that allows us to invest back in the business. In our mid-cap sort of sector, we are one of the strongest when it comes to operating EBITDA. So we feel that there's more focus that's required to grow in certain markets. We've moved the needle on capabilities in data, in managed services, but there's more to do. So yeah, I mean, the high teens is kind of what we want to aspire for.
Tell me, last year was sluggish because, you almost had a 60% exposure to UK, Europe, and, then there was the entire Ukraine war situation. Have you managed to diversify out of the government contracts in these regions? And then what's the timeline for the NHS contract ramp up as well, if you could highlight that?
Sure, absolutely. So our UK business is quite unique, as we've discussed in the past. There is very underlying, national infrastructure importance type of work that we do in immigrations, borders. In fact, one of the deals we won is in the biometric space for managing legal immigration into the UK. And the type of work that we do, we believe will continue to be resilient. We have, having said that, diversified in manufacturing and a couple of other industries like retail. Our US business is roughly around 26% now of the overall mix. We see that growing to about 33% in the next year or so. I think, overall, we feel happy with the diversification, even from a platform perspective. We do have a strong Oracle Cloud business, which will continue to thrive. We have now a strong Salesforce business, and our digital engineering business has always been strong. So we feel that we have some of the pieces of the puzzle. We're investing in data and analytics. We see potential for non-linear growth in that space, including AI. And I think the movement of dependency on UK has definitely come down. But UK continues to be an important sector for us. So we'll see continued growth in FY24, even from that geography, while definitely faster growth in Americas and in Middle East, relatively speaking.
Okay. And order bookings for you have been quite strong this quarter. Is that looking sustainable?
Sorry, say that again?
I'm talking about your order bookings, which have been fairly strong. Is that looking sustainable?
Yeah, order booking, we had a couple of challenging quarters with deal delays in the previous quarters, but the Q4 order booking was strong. The Q4 in-quarter book and bill ship was also very strong. So you're seeing that reflecting in the revenue results as well as in the order backlog. So we feel that order booking is just going to go up from here. I mean, some of the foundational work, like I said, we've done in the last year or so in terms of recruiting, marketing, our brand recognition, our people element of it, right? Our attrition has dropped down 700 bips to 21%. We probably look at another 2-3% of reduction of that. We've gotten recognized by GPTW, Great Places to Work. ISG has recognized us as the booming 15. So we have a seat at the table now for some of the larger enterprises and clients, and even ability to shape larger deals and constructs, particularly in some markets where we have market permission. And so order book, I'm bullish. We have the foundation laid to grow, beyond what we've done even in Q4.
Just one final question, and I can't not ask you about your reading of client behavior, especially in US and Europe. Are the deal cancellations, ramp downs, rethinking?
Yeah, it's kind of interesting, right? Because there is definitely growing caution. If you look at some of the reports, if you look at some of the voice of the customer, if you will, what they're trying to look at is, a lot of investments have been made in moving to the cloud, hyperscalers. So they're focused on how do we get the most out of these investments, right? So, and that's kind of, in a way, in our sweet spot as well, right? Once companies move to the cloud, we're very good at actually creating solutions and with cloud native and API technologies, getting value out of the ROI, right? So whether it's Oracle Cloud, Salesforce, Snowflake, ServiceNow, these are a few of the platforms that we're focused on. Customers have made investments. So while they might continue to make investments, incrementally, they want to get more out of it. So that's one behavior. The second one is, while they're cautious, one learning from COVID is that they're not necessarily stopping, at least, our customers are not necessarily stopping or pausing. They might repurpose some of the focus and combining that with saying, hey, if we spend, XYZ pounds or dollars, how do we save money in the process as well, right? As a result of that. So that's why our value proposition of combining when we do an implementation or a project, how do we combine that with optimization and the ROI out of it is the other part of the client behavior. But, there is uncertainty. Our exposure to Europe, which is outside of UK, is very low. That's a very, negligible part of our business. At some point, it might grow, but so we're not that impacted with the Ukraine situation as such. But otherwise, cautious behavior, I feel, will continue for the next 2 to 3 quarters in the industry. It's the customer advocacy, the customer, flavor, even industry-specific flavor. I was talking about healthcare, whether it's nurses shortage or patient experience or looking at interoperability between different systems. There is so much legacy in some of these environments that there's a huge opportunity to save costs for our customers. So there definitely conversation has changed in the last 3-6 months to, while we digitize, while we move to the cloud, how do we save money, right, in the process and get most from our investments?
I must say thank you so much for that, because you've been more candid and more clear in highlighting what the client behavior is than some of your other peers in the industry so far. Good to have you on the show as always.
Thanks. Always a pleasure. Appreciate it.
Okay, that's Mastek.